So let us look at financial statements. Financial statements. Financial statement analysis. Financial statement analysis and forecasting. And forecasting. Financial statement analysis and forecasting. Financial statement analysis and forecasting. That is what I want us to discuss today. That is what I want us to discuss today. The financial statement analysis and what? And forecasting. Financial statement analysis and forecasting. Financial statement analysis and forecasting. Say, this includes identifying and analyzing various financial statements of the company. This includes identifying and analyzing various financial statements of the company in order to determine the strength and weaknesses. This includes identifying and analyzing various financial statements of the company in order to determine the strength and weaknesses, opportunities, as well as threats. This includes identifying and analyzing various financial statements of the company in order to determine the strength and weaknesses, opportunities, as well as threats. Then from there, we look at the key terms. Let us look at the key terms. We look at the key terms. And one of the key terms I want us to look at is what we call the operating profit. Number one, operating profit. We talk about the operating profit. Let us talk about the operating profit. And when we are talking about the operating profit, write and say, this refers to the earnings. 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 This refers to the earnings before interest and tax. This refers to the earnings before interest and what? Interest and tax. That is what we refer as operating what? Operating profit. Remember, when we talk about the income statement, for example, we are talking about the income statement. We normally start with what? Revenue. Then from the revenue, you raise what? Cost of sales. Then once you raise the cost of sale, you will get what we call the gross what? Gross profit. Gross profit. Once you get the gross profit, you are going to raise what? The operating expenses. Operating expenses. Operating expenses such as what? We have what we call the selling and distribution, and also we have the admin. So therefore, then once you do that, you are going to get the operating. Operating what? Profit. Operating profit is the same as earnings before interest and what? Tax. This is what we call the operating profit. That is one of the key terms. That is one of the key terms. Another one is equity or net worth. Number two, let us talk about the equity or what we call the net worth. Equity or what we call the net worth. Equity or what we call the net worth. And write and say, this refers to the shareholders fund. This refers to the shareholders what? Shareholders fund. This refers to the shareholders fund. That is what we call the equity or net worth. Then from there, the next one, number three, we have what we call the capital employed or net asset. Number three, we have capital employed or what we call the net what? Net assets. Capital employed or net assets. and write and say that this is the total asset minus current liabilities. This is the total asset minus what? Minus current liability. This is the total asset minus current liability. That is what we refer as what? Capital employed or net asset. Below the right hand side, it represents equity plus preferential capital plus long-term debt. It includes nini? We have equity. It includes equity, preference share capital, and what? And long-term what? Long-term debt. And long-term debt. It includes equity, preference share capital, and long-term debt. Then number 4, we have investments. Number 4, we talk about investments. And what do we mean by investments? Write and say that this refers to the total asset. This refers to the total asset. That is what we call what? The investment. Then from there, I want us to look at the financial ratios. Financial ratios. Write and say ratios can be categorized into 5 categories as follows. So we have number 1, we will be talking about the investors. Investors or valuation. What? Ratios. Investors or valuation ratios. Number 2, we have the liquidity ratios. Number 3, we will talk about the gearing or leverage. What? Ratios. Gearing or leverage ratios. Then number 4, we have profitability ratios. Then number 5, we'll talk about the activity efficiency. Sometimes we call it the turnover, or we have what we call the asset utilization. What? Ratios. So these are the financial ratios which we are going to describe and see how many ratios, for example, we'll be talking about when we talk about the investors or valuation ratios, liquidity ratios, we have gearing or leverage ratios, we have profitability ratios, we have activity or efficiency or turnover, then we have the asset utilization what? Asset utilization ratio. So therefore, let us start with the first one. The first one is investors or valuation ratios. Investors or valuation ratios. And write and say these ratios are used to determine the value of the company. These ratios are used to determine the value of the company. They include number one, when we talk about the investors or what? Valuation ratios. Number 1, we have what? We have the earnings per share. Earnings per share, into bracket we call it EPS. Earnings per share, into bracket we call it what? EPS. So write and say that this ratio indicates the profitability. This ratio indicates the profitability available to each share held by the investor. This ratio indicates the profitability available to each share held by the investor. This ratio indicates the profitability available to each share held by the investor. So therefore, we talk about the EPS. So how do we get the EPS, or earnings per share? Earnings per share is given by the earnings. We normally talk about the earnings attributable. Earnings attributable to ordinary shareholders. Earnings attributable to ordinary shareholders. Then you divide by the number of ordinary what? Ordinary shares. Number of ordinary shares. So for you to get the EPS, you are going to take the earnings attributable to ordinary shareholders, then you divide by the number of ordinary shares. And in this case, it is going to depend with the information that you are going to have. Remember, we have talked about the income statement, and we say that our income statement looks like this, where we have the revenue. Then from there you raise what? The cost of sales. Then once you raise the cost of sale, we say you get the gross profit. Once you get the gross profit, we say you raise the operating expenses. And from the operating expenses, you get what? You get the operating what? Operating profit. From the operating profit, you need to raise what? You raise the interest. Once you raise the interest, you are going to get the earnings before tax. Once you get the earnings before tax, then you raise what? Income tax expense. Then from there you will get the earnings after tax. You get the earnings after tax. In some circumstances, you can find that the company is financed by the three categories of finances. Number one, the company is financed by what? Ordinary shares. Number two, the company is financed by the preference shares. And also the company is financed by what? By debt or debentures or loans. So in this category, the interest we are talking about will come from what? From the debt. Then once you have reached the earnings after tax, you are supposed to raise what? You raise the preference dividends. Once you raise the preference dividend, then you can get the earnings attributable to ordinary shareholders. Whatever that you have described here, the earnings attributable to ordinary shareholders. Then from there, you are going to confirm how many ordinary shares you have in a given company, so that you can get the earnings per share. So anytime you find that the company is financed by three, you must get the earnings attributable to ordinary shareholders. Anytime you find that a company is only financed by the debt and equity, therefore, these our earnings after tax, in that case now becomes the earnings attributable to ordinary shareholders. So that's how you get the EPS. That is how you get the EPS. Then we go to number two, dividend per share. Number two, we talk about the dividend per share. Dividend per share, DPS, we call it the DPS. Let us talk about the DPS, dividend per share, DPS. So write and say that this indicates the actual cash received by an investor as dividends for each share held. These indicate the actual cash received by an investor as dividends for each share held. It is calculated as follows. It is calculated as follows. It is calculated as follows. So how are you going to get the dividend per share? This is how you will get the dividend per share. The dividend per share. This is how you are going to get the dividend per share. So for you to get the DPS, you will take the total dividends. Total dividends declared and paid. Total dividend declared and paid. Then from there you divide by the number of ordinary shares. You divide by the number of ordinary shares. In case we have any other information, for example, let's assume we had the earnings per share. If we had the earnings per share, then we can use this earnings per share for us to get the dividend per share. How can we use it? We will take the earnings per share for us to get the dividend per share. We take the earnings per share, then we multiply by the dividend. We multiply by the dividend payout ratio, the dividend payout ratio. You can find that a company has what we call the retention ratio of, let us say, 60%. So if the company is retaining 60% in the company, therefore the payout ratio will be how much? 40. Payout ratio in this case will be 40%. So therefore, depending on the earnings per share that you have gotten, you will take that earnings per share, then you multiply by the dividend payout ratio. So that's how you are going to get the dividend per share. That is how you will be getting the dividend per share. Then we go to number 3. Number 3, we talk about the earnings yield. Number 3, we talk about the earnings yield. Number 3 is the earnings yield. Earnings yield. We talk about earnings yield. EY, earnings yield. And write and say that this indicates the percentage return for every amount invested in the company. This indicates the percentage return. This indicates the percentage return for every amount invested in the company. This indicates the percentage return for every amount invested in the company. And how are you going to get the earnings yield? For you to get the earnings yield, you are going to take the earnings per share, then you divide by the MPS, and then you multiply by what? By 100. Remember, when we talk about the MPS, this is the market price per share. The market price per share. That is the market price per share. The market price per share. Then from there, number 4, we talk about the dividend yield. Number 4 is the dividend yield. Number 4, we talk about the dividend yield. Dividend yield, DY. Dividend yield is our DY. And write and say that this indicates the percentage return in the form of dividend. This indicates the percentage return in the form of dividend for every amount invested into the company. This indicates the percentage return in the form of dividend for every amount invested in the company. For every amount invested in what? In the company. So you can look at this. So therefore, how do you get the DY or dividend yield? The dividend yield will be given by the dividend per share. Then you divide by what? The market price per share. Then you multiply by 100. The same case we did here. We took the earnings per share, and then this y tunaichukulia kama nini? Our market price per share. So anytime the examiner will be asking you about the earning yield, where automatically unajua hapa juu unaenda na nini? EPS. Chini yake ni MPS. Then about the dividend yield, kawaida hapo juu ni DPS, chini yake una divide na nini? Chini yake una divide na MPS. Then from there we go to the dividend payout ratio. Dividend payout ratio. Number 5, dividend payout ratio. And right hand side that this indicates the proportion of the earnings available to ordinary shareholders which is paid. This indicates the proportion of the earnings available to ordinary shareholders which is paid. So therefore, the question arises, how do you get the dividend payout ratio? How do you arrive at the dividend payout ratio? So for you to get the dividend payout ratio will be given by what? In this case, for you to get the dividend payout ratio, you are going to take the dividend. You take the dividend payout ratio. In this case, you are going to take the retention one. Yeah, we talk about one. Then you subtract what? You subtract the retention. Retention what? Retention ratio. You take one, you minus what? You minus the retention ratio. Remember, right in this case I explained. I said that the retention ratio, for example, is 60%. Therefore, if we were to get the dividend payout ratio, we should have taken 1 minus what? Or 100, because this was in a percentage, it will be 100% minus what? 60%. And therefore, in that case, you are going to get what? The dividend payout ratio. That is how you get the dividend payout ratio. The dividend payout ratio. Also, we said that for us to get the DPS, remember we said we can take the EPS, then we multiply by what? The dividend payout what? Payout ratio. So therefore, how can we get now using this? We can use this and make this the subject of the formula, isn't it? So if we make this the subject of the formula, it means that for us to get the dividend payout ratio will be, let us make this the subject of the formula. What do you think? I think it is going to be EPS or DPS. It is going to be earnings per share.
DPS or EPS.
If we make this a subject, we need this. So therefore, we need this one. So if we divide by EPS, and we divide by the EPS, isn't it? So it is the DPS. Is it the DPS or EPS?
DPS or EPS.
Dividend per share. Dividend per share. Or over what? Or over earnings per share. Yeah, that is okay. So for us to get the dividend payout ratio, we take the dividend per share, we divide by the earning per share, because if we have to, ukichukua your DPS is equals to EPS times what? Dividend payout ratio, then you divide by what? Hapo utadivide na EPS, na hapo udivide na EPS. So this goes, and therefore your dividend payout ratio will be remaining in that case. So that's about the dividend payout what? Dividend payout ratio. Dividend payout ratio. Then from there we go to number 6, dividend cover. Number 6 is the dividend cover. We look at the dividend cover, and right and say this indicates the number of times ordinary dividend is paid out from the earnings available to ordinary shareholders. This indicates the number of times ordinary dividend is paid out from the earnings available to ordinary shareholders.
So it is times of ordinary share.
The number of times
Of ordinary share.
the dividend is paid out of what? Ordinary shareholders. Ordinary shares, not shareholders, ordinary shares. So therefore, let us look at how can we get the dividend what? Dividend cover. The dividend cover tunaipata namna gani? DC. DC will be given by we have said it indicates what? The number of times the dividend can be paid out of what? Out of the ordinary share. So therefore it will be EPS over what? DPS. And in that case, ukipata answer unaandika ni mara ngapi. It is very important when it comes to the ratios. If the ratios are in form of shillings, if the ratios are in form of times, it's very important for you to indicate. Or sometimes you can present them as what? As ratios. 1 is to 2, 2 is to 3, 3 is to 1. Yes.
Because the number of times of dividend.
This indicates the number of times ordinary dividend is paid out from the earnings available to ordinary shares. Earnings available to ordinary shares. The last one under valuation ratio is the price earning ratio. Price earning ratio. Price earning ratio is the last one. Price earning ratio. Price earning ratio. Price earning ratio. And write and say that it shows the relationship between the MPS and the EPS. It shows the relationship between the MPS and EPS. So therefore, how can you get the PE ratio? I normally call it the PE ratio. PE ratio is given by the MPS or over what? EPS. MPS over EPS. You get what? You get the PE ratio. That is how you are going to get the PE ratio. PE ratio. PE ratio. So that's how you do what we call the ratios under the valuation ratios. Under the valuation ratios, there are 7 of them. Number 1, we talked about the EPS. Number 2, we talked about the DPS. Number 3, we talked about what? Earning yield. Then number 4, we talked about the dividend yield. Number 5, we talked about what? Dividend payout ratio. Number 6, we talked about the DC, ambayo ndio dividend cover, na ya mwisho ilikuwa ni gani? Ilikuwa ni PE ratio. PE ratio. PE ratio. Let us go to the second one. The second one was talking about what?
Liquidity.
The second one was talking about the liquidity ratio. Liquidity ratio. We talk about the liquidity ratio. Liquidity ratio. Number 2 is liquidity ratio. We talk about the liquidity ratio. Liquidity ratio. And write and say that these ratios indicate the ability of the company to meet its short-term financial obligations. These ratios indicate the ability of the company to meet its short-term financial obligations. These ratios indicate the ability of the company to meet its short-term financial obligation. They include, we have the current ratio. They include, number 1, we talk about what? The current what? Current ratio. We talk about the current ratio. And right and say, when we talk about the current ratio, it indicates the number of times current liabilities can be paid out of the current asset. It indicates the number of times current liabilities can be paid out of the current assets. The recommended ratio is 2:1 or 2 times. The recommended ratio is 2:1 or 2 times. The recommended ratio is 2:1 or 2 times. 2:1 or 2 times. Remember, when we talk about the statement of financial position, statement of financial position is made up of assets, and these assets are categorized into two. We have the non-current assets, whereby in the non-current asset we talk about property. We have property, plant and what? Plant and equipment. Property, plant and equipment. Then we have intangible assets. Then we can talk about investment what? Investments, and also we can talk about investment what? Investment property. Then we go to the current assets. Current assets, we have what? We have inventory. Then we have trade what? Trade receivables. Then we can talk about cash and what? And cash equivalent. Cash and cash equivalent. So that is what we have. Then we go to equity. Equity and what? And liabilities. Equity and liabilities. And under equity and liabilities, we start with equity. And for the equity, we have what? Ordinary. We have ordinary share capital. Then above there we have the share premium. Then we have revaluation what? Revaluation reserve. Then we have the retained what? Retained earnings. Then from there we can talk about also the preference. Preference share what? Share capital. Preference share capital. So then from there we go to non-what? Non-current liabilities. Non-current liabilities, like we have the long-term what? Long-term loans. Then we have debentures. And then we can talk about what? We can talk mostly about the deferred tax. Then finally we have what? Current. We have current liabilities. And when we talk about the current liabilities, in this case we'll be talking about what? Trade what? Trade payables. We have trade payables. We have the bank overdraft. And also we can talk about the current what? Current tax. So therefore, that is the statement of financial position. So therefore, when we are talking about the current ratio, it shows the number of times the current assets are going to be able to pay the current what? Yeah. The current liability. So therefore, how do we get the current ratio? The current ratio will be given by the current asset divided by what? Current liability. And the current asset which we will be talking about are these ones. Inventory, then we have trade receivables, then we have what? Trade payables. When you accumulate, whatever you will get, that will give us the current assets. And the current liability we will be talking about, this will be the current liability, the trade payables, bank overdraft, current tax, if they are available. Whatever that is available under the column of what? Or under the under the current liabilities. You accumulate all of them, and then you see how many times the current assets are going to be able to pay what? Current liability. That's how you get it. Then from there, we go to the next one. The next one is the quick ratio or acid test ratio. We have the quick ratio or acid test ratio. We have the quick ratio or acid test ratio. Right, I said it indicates the ability of the company to meet its current liabilities from its most liquid current assets. It indicates the ability of the company to meet its current liabilities from its most liquid current assets. The recommended quick ratio is 1:1. The recommended quick ratio is 1:1. The recommended quick ratio is 1:1. So we talk about the quick ratio, or what we call the acid test ratio. How do you get the quick ratio or acid test ratio? Again, you are going to take the current asset minus what? Minus inventory, minus average inventory. We talk about the average what? Inventory, or minus inventory. Then from there you divide by what? You divide by the current liability. You divide by the current what? Current liability. You divide by the current liability. So utakuwa ukichukua current asset, then you raise what? It's not the average, but just inventory. And then from there, because tukisema average ni kama uko na opening and closing, which is not true. We are going to take this inventory ndio tunatoa from the total of this current what? Current assets. So the current asset minus this inventory, then you divide by the current liability. Current liability. Then below there, write and say that stock is excluded. Stock is excluded from calculating quick ratio because of the stock is excluded from calculating the quick ratio because of semicolon. Roman 1, it may be difficult to convert inventory into cash immediately. It may be difficult to convert inventory into cash immediately. It may be difficult to convert inventory into cash immediately. And 2, inventory is valued at the lower of historical costs. Inventory is valued at the lower of historical costs and net realizable value. Inventory is valued at the lower of historical cost and net realizable value. And net realizable value. Then from there, let us look at the cash ratio. We look at the cash ratio. We look at the cash ratio. We look at the cash ratio. Cash ratio, and write and say that it indicates the ability of the company to meet current liabilities from its most liquid current assets. It indicates the ability of the company to meet current liabilities from its most liquid current assets. It indicates the ability of the company to meet current liabilities from its most liquid current assets and short-term marketable securities. It indicates the ability of the company to meet current liabilities from its most liquid current asset and short-term marketable securities, e.g. commercial papers, we have treasury bills, financial asset at fair value, e.g. commercial papers, treasury bills, financial assets at fair value, So therefore, how are you going to get the cash ratio? Cash ratio ukiangalia ni hii tuko nayo hapa. So you will take cash and what? You are going to take cash and cash equivalent. Cash and cash equivalent. Then from there you divide by what? You divide by. So you will take cash and cash equivalent. Then we divide by the current what? Current liabilities. So that is number 2. For number 2, we have how many ratios? 3 of them. We have the current ratio, whereby is given by the current asset, you divide by current liability. We have the quick ratio or asset test ratio, where you take the current assets minus inventory, you divide by the current liability. Then from there we have the cash ratio, where you are going to take the cash and the cash equivalent, then you divide by the current liability. So if we can accumulate our ratios, we are already in ratio number 10. Ratio number 1 was EPS, number 2 was DPS, number 3 was dividend yield, earning yield, number 4 was dividend yield, number 5 was the dividend payout ratio, number 6 was what? Number 6 was the dividend cover, number 7 was the payout ratio, PE ratio, payout ratio. And then number 7 was current ratio, number 8, current ratio, number 9, quick or asset test ratio, and now number 10 is cash ratio. Then we go to the next one. The next one is gearing or leverage. Or sometimes we call it what? Capital structure ratio. Gearing, we talk about the gearing or leverage. Or capital what? Capital structure ratios. Gearing or leverage or capital structure ratios. Right answer, they indicate the extent to which the company has borrowed fixed return capital to finance its assets. They indicate the extent to which the company has borrowed fixed return capital to finance its asset. Below there, we are told that the ratios include, number 1, we have debt to equity ratio. So A, we have debt to equity ratio. Or what we call the capital gearing ratio. So debt to equity ratio or capital gearing ratio. So right answer, this ratio indicates the amount of long-term debt. For every 1 shilling of equity. This ratio indicates the amount of the long-term debt for every 1 shilling of equity investment
in the company. This ratio indicates the amount of the long-term debt for every 1 shilling of equity investment in the company. Equity investment in the company. So therefore, how do you get this ratio, debt to equity ratio? So for you to get the debt, debt to equity ratio, for you to get the debt to equity ratio, you are going to take what? You will take what we call the long-term debt. You are going to take the long-term debt, long-term debt, or fixed, sometimes we call them the fixed return capital, then you divide by what? You divide by the equity, then from there you multiply by what? You multiply by 100. It's like in this case, you will take this long term and this one debentures, and then from there you take preference. Preference will be part of it. So you take this plus this plus this, and then you divide by what? By the equity. The equity will be this one, and this one. Yes, in most cases, the
Equity.
preference share capital.
So equity will be ordinary share premium,
Yes,
revaluation reserve, and retained earnings.
and retained earnings. Hiyo ndio equity. Yes. So debt to equity ratio, utachukua long term debt or fixed return capital. This one we normally call it a fixed return capital because in most cases tutakuwa umeambiwa 10% what? Preference. 10% preference. Hii long term loan maybe utakuwa umeambiwa ni 10% bank loan. Na hii ingine maybe utakuwa umeambiwa ni 12% what? Debentures. So we are calling them the fixed return because either you make a profit or you don't make a profit, they will get their share. They are going to get their share in the company. So below there, right and say fixed charge capital includes preference share capital and debentures. Fixed charge capital includes preference share capital and debentures. They include preference share capital and debentures. So that's number one. Then let us look at the second one under this case. So the second one under this case, we talk about debt ratio or fixed or financial gearing ratio. Debt ratio, or what we call the financial gearing ratio. Debt ratio or financial gearing ratio. So right and say, this ratio indicates the ability to which the total assets of the company. This ratio indicates the ability to which the total assets of the company have been financed with the liabilities. This ratio indicates the ability to which the total assets of the company have been financed with the liabilities. So therefore, how do you get debt ratio? The debt ratio is going to be given by, you are going to take what? For you to get the debt ratio, you will take the total what? Total liabilities. And when I'm talking about the total liabilities, I'm talking about non-current liabilities plus what? Current liability. Then we divide by what? Total assets. You divide by the total assets. Then you multiply by what? You multiply by 100. So therefore, if we go to our statement of financial position, you will be talking about non-current liability plus current liabilities. then you divide by the total assets, then you multiply by 100%. You multiply by 100%. So that's about that. Then we go to number 3. Number C, we talk about fixed charge ratio. Fixed charge ratio. Let us talk about the fixed charge ratio. Fixed charge ratio. Fixed charge ratio. Fixed charge ratio. We talk about fixed charge ratio. So our C is what? Fixed charge ratio. Fixed charge ratio. Fixed charge ratio. And write and say the ratio indicates the proportion. The ratio indicates the proportion of the total capital. The ratio indicates the proportion of the total capital, which has a fixed rate of return. The ratio indicates the proportion of the total capital, which has a fixed rate of return in relation to the total capital. The ratio indicates the proportion of the total capital, which has a fixed rate of return in relation to the total capital. In relation to the total what? Total capital. In relation to the total capital. So therefore, how do you get the fixed charge? You are going to take the fixed what? Fixed return capital, or you can call it the fixed charge, or over what? Or over total capital. Total capital, then you multiply by what? By 100. You multiply by 100. Any question?
The total capital.
Total capital. When we are talking about the total capital, in most cases, the total capital is, we normally talk about equity and what? And long-term debts. Equity and long-term debt. Remember, the capital is what you are using to finance a given company. So therefore, when we talk about the capital, you can finance your company using what? Okay. Using equity, using preference share capital, and also using debt. Using debt. So when you take the debt plus preference plus equity, you get what? You get the total capital. You get the total capital. So that is the total capital. In this case, we will be talking about. That is the capital which we are going to be talking about. Then we go to the next one, interest cover ratio. The next one is interest cover ratio, or times interest cover ratio, or what we call the times interest earning ratio. Times interest earning ratio. We have the interest cover ratio, or times interest earning ratio. Times interest earning ratio. Times interest earning ratio. And write and say that this indicates the number of times interest expense can be paid. This indicates the number of times interest expense can be paid from the operating profit before profit get exhausted. This indicates the number of times interest expense can be paid from the operating profit before profit get what? Exhausted. This indicates the number of times interest expense can be paid from the operating profit before profit get exhausted. So therefore, how do you get the interest cover ratio? interest cover ratio or times interest earning ratio is going to be given by the operating profit, which is the earnings before interest and tax. Then you divide by what? You divide by the interest expense. You divide by the interest expense, and then you get the number of times, that we are going to pay this, the number of times. Then number E, equity multiplier ratio. We talk about the equity multiplier ratio. Equity multiplier ratio, right hand side. This shows the relationship between the total assets and shareholders' equity. This shows the relationship between the total assets and shareholders' equity. This shows the relationship between the total assets and shareholders' what? Shareholders' equity. And how do you get the equity multiplier ratio? You are going to take what? For you to get the equity multiplier ratio, you take the shareholders' what? Funds or equity. We'll be talking about the shareholders' funds, shareholders' fund or equity. Then you divide by what? You divide by the total assets. Yeah, shareholders' funds or what we call the equity. Then you divide by what? We have said this shows the relationship between the total assets and what? And the shareholders' equity. Sorry. So the vice versa is the case. The vice versa is the case. Yeah, we are going to take the total what? Total assets. Then we divide by what? Shareholders' equity. Shareholders' equity or just equity. Equity inakuwa ni ya shareholders. The equity is for the shareholders. So that is the ratio number.
Under that case, shareholders' equity. Are we going to include the preference?
Yeah, this will not be included.
Are we going to include?
It is not included in this one. We are going to include these ones. These are the ones which will be inclusive for us to get the shareholders what? The shareholders' equity. The shareholders' equity. So that is the ratio number 3. We are done with the ratio number 3. Then straight away we go to ratio number 4. Straight away we go to ratio number 4. Tuko kwa ratio number 4. So ratio number 4. Ratio number 4 ilikuwa ni profitability ratios. We talk about profitability ratios. We talk about profitability ratios. And right and say, these ratios indicate the ability of the company to generate returns in relation to investments and sales. These ratios indicate the ability of the company to generate returns in relation to investments and sales. They are classified into two. We have profitability in relation to sales. We can call it Roman 1, profitability in relation to sales. And Roman 2, we have what? Profitability in relation to what? In relation to investment. Profitability in relation to what? To investments. So we start with the first one. Profitability in relation to what? Profitability in relation to sales. We start with the profitability in relation to sales. And this profitability in relation to sales, I don't want to have this financial statement. But I want now to include what? I want to have also, in this case, we have the income what? Statement. Income statement. And our income statement, remember, we are going to have the revenue. Then we have the cost of sales. Then from there we have the gross profit. Then from the gross profit we said we get what? Sorry, this gives us the gross profit. Then from there we have the operating what? Operating expenses. And then from the operating expenses, we said we get the earnings before interest and tax, or what we refer as the operating what? Operating profit. Then from there we less what? Interest. Once we less the interest, we are going to get the earnings before tax. Then from there we less tax, income tax. Then once we less the income tax, we get the earnings after tax, or retained profit, or profit for the year. Profit for the year. That is the income statement, and we have the statement of financial position. So now we are talking about profitability in relation to what? To sales. And in this case, one of the ratios under that we are going to talk about is the gross profit margin. The gross profit margin. How do we get the gross profit margin? How do we arrive at the gross profit margin? In this case, we will be taking this one, gross profit. So utachukua gross profit. Then you divide by what? You divide by the revenue. Revenue also is known as what? Sales. So you are going to divide by the revenue or the sales. Then you multiply by 100%. You multiply by 100%. You multiply by 100%. Then we go to the next one, is the operating profit margin. How do we get the operating profit margin? How do we come up with operating profit margin? For us to have the operating profit margin, we are going to take the operating profit. Remember, these earnings before interest and tax is our operating what? Operating profit. Earnings before interest and tax. Then we divide by what? We divide by sales or revenue. Then we multiply by 100%. We multiply by 100%. We multiply by 100%. Then how are we going to get the net profit margin? The net profit margin. Net profit margin. So the net profit margin will be given by what? Earnings after tax. This is our net profit. So it will be earnings after tax, or the net profit. Then we divide by revenue or the sales. Revenue. Then we multiply by what? 100%. Then how do we get the operating? How do we get the operating expense ratio? Operating expense ratio. Operating expense ratio. The operating expense ratio in this case will be given by, you will take the total expenses. You will take the total expenses. The total expenses, then you rest what? You rest the interest expense. Interest expense. Then from there you divide by the revenue. You divide by the revenue. Then you multiply by what? By 100. Yeah? You multiply by 100%. That is how you get the operating expense ratio. That is how you'll be getting the operating expense what? Expense ratio, operating expense ratio. So the total expenses are this operating expense plus what? Plus the interest. Like in our format, you should have just taken the operating expense, then you divide by what? By the revenue. For you to get the total expenses is this one plus this one. Huh?
Yeah.
Yes, plus the interest expense. But anytime you are given the operating expense, for you to get the operating expense ratio, you just go direct with the operating expense
So we
ratio.
are not including.
Then you divide by what? By the
We can't include the income tax. Income tax is not.
no. Income tax is not included because when we talk about total expenses, ni hii na hii, sio hii. Hii sasa ni after umepata profit, now you are paid the revenue authority what you owe them. Huh? Yes, hiyo ndio tunaita nini? Income tax. Income tax. So that's about the profitability in relation to what? In relation to sales. Profitability in relation to sales. Let us look at the profitability in relation to investment. Profitability in relation to what? To investment. Profitability in relation to investment. Profitability in relation to investment. Profitability in relation to investment. They include return on investment or return on total assets. We have return on investment, or return on total what? Total assets. Return on investment or return on total assets. Return on investment or return on total assets. And I can say this indicates the percentage return. This indicates the percentage return from the utilization of the total assets. This indicates the percentage return from the utilization of the total assets. This indicates the percentage return of the company from the utilization of the let me come again. That information is not okay. This indicates the percentage return from the utilization of the total asset. From the utilization of the total asset. So therefore, how do you get the return on investment? Low E. Return on investment will be given by what? For you to get the return on investment, utakuwa unachukua net profit, what we call earnings after what? After tax, you divide by what? You divide by the total assets, then you multiply by 100. Unachukua net profit, or what we call the earnings after tax, then we divide by the total assets, then from there you multiply by 100. You multiply by 100. That's how you get the return on investment. Then we go to number 2, or number B of that. We talk about the return on equity or return on net worth. So here we have return on equity, or what we call the return on net worth. Return on equity or return on net worth. Return on equity or return on net worth. Right hand side, it indicates the percentage return of company. It indicates the percentage return of company from utilization of shareholders' funds. It indicates the percentage return of company from utilization of shareholders what? Shareholders fund. Shareholders fund. How do you get the return on equity? The return on equity will be given by the net profit, or what we call earnings after tax. Then you divide by what? You divide by the equity. You divide by the equity. You divide by the equity, or what we call the shareholders what? Shareholders fund. Then you multiply by 100%. 100%. Then C, part C, we talk about the return on net asset. The return on net asset. Return on net assets. Return on net assets, or what we call return on capital. On capital employed. Return on capital employed, what we call LOC. 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 Right hand say it indicates the percentage return. It indicates the percentage return from utilization of net assets. It indicates the percentage return from utilization of net assets. It indicates the percentage return from utilization of what? Of net assets. So therefore, how do you get ROCE? ROCE is given by the operating profit. Operating profit, that is the earnings before interest and tax. Then you divide by what? You divide by the net assets, or what we call the capital. Capital employed. Capital employed. Then you multiply by what? You multiply by 100. You multiply by 100. You multiply by 100. That is how you are going to get ROCE. That is how you will be getting ROCE. ROCE tunaipata namna gani? Namna hiyo. That is how we get our ROCE. That's how we will be getting our ROCE. So we are done with the ratio number 4, profitability ratios. We have summarized the profitability ratios. Now we go to the final one. The final one ilikuwa ni gani?
Activity.
The final one was activity, efficiency, turnover. The final one, number 5, was activity, efficiency, turnover, or asset what? Asset utilization ratio. Asset utilization ratio. That is, this is our final what? Our final ratio. Our final ratio. Right, and say these ratios indicate the efficiency with which the company utilizes its resources. These ratios indicates the efficiency with which the company utilizes its resources in order to generate the revenue. These ratios indicate the efficiency with which the company utilizes its resources in order to generate the revenue. In order to generate the revenue. They include, number 1, we have stock or inventory turnover. Number 1, we have what we call stock or inventory turnover. We have stock or inventory turnover. Stock or inventory turnover. Stock or inventory turnover. And write and say, it indicates the frequency with which inventory is converted into sales. It indicates the frequency with which inventory is converted into sales. It is calculated as follows. It is calculated as follows. It is calculated as follows. How do you get the stock or inventory turnover? You are going to take, it is going to be given by the cost of goods sold. Cost of goods sold, then you divide by what? Average inventory. You divide by the average inventory. You take the cost of goods sold, then you divide by the average what? Average inventory. You divide by the average inventory. You divide by the average inventory. Below there, write and say average inventory. If you want to get average inventory, average inventory is going to be given by the opening inventory plus what? Closing inventory. Then you divide by what? You divide by 2 for you to get the average. You divide by 2 for you to get the average. You divide by 2 for you to get the average. Then below there, write and say, where there is no opening inventory, closing inventory is assumed to be the average inventory. Where there is no opening inventory, closing inventory is assumed to be the average what? To be the average inventory. Where there is no opening inventory, closing inventory is assumed to be the average inventory. Then we go to number 2. Number 2, we have debtors or receivables turnover ratio. Number 2, this was number A. Then B, we talk about debtors stroke what? Receivables what? Turnover ratio. Receivables turnover ratio. Debtors or receivables turnover what? Turnover ratio. Right, and say it indicates the frequency with which customer buy goods on credit. It indicates the frequency with which customer buy goods on credit. It indicates the frequency with which customer buy goods on credit. Customer buy goods on credit. So therefore, how do we get the debtors or receivables turnover? It's going to be given by the credit what? Credit sales. Then you divide by the average what? Average receivables or debtors. Average receivables or debtors. Average receivables or debtors. Average receivables or what? Or debtors. Then number 3, we talk about the creditors. Or what we call the payables. Payables turnover. We have creditors or payables turnover. Right, and say it indicates the relationship between credit purchases and average creditors. It indicates the relationship between credit purchases and average creditors. It indicates the relationship between the credit purchases and average creditors. So therefore, how do you get the creditors or payables? You take the credit what? Credit purchases, then we divide by what? Average payables. Credit purchases, then is divided by the average payables. You take the credit purchases, then you divide by the average what? Average payables. Then we go to the next one, fixed asset turnover ratio. We have fixed asset turnover ratio, fixed asset turnover ratio, fixed asset turnover ratio. And how do you get the fixed asset turnover ratio? You are going to take the sales, then you divide by the fixed assets. You take the sales, then you divide by the fixed assets. Then we have the total asset turnover or investment. We have the total assets turnover, or what? Or investment. Investment turnover ratio, investment turnover ratio, total asset turnover or investment turnover ratio. In this case, you will get it by taking the sales or over what? Or over total assets. Or you can say or over what? Or over investment. Yeah, sales or over total assets. Then we are in number 6. Number 6, we are going to talk about what? The stock or inventory holding period. Okay. Stock or inventory holding period. Stock or inventory holding period. Stock or inventory holding period. Stock or inventory holding period, and write and say it indicates the number of days that the stock is held in warehouse before being sold. It indicates the number of days that the stock is held in warehouse before being sold. It indicates the number of days that the stock is held in warehouse before being sold. Before being sold.
Excuse me. These are for total assets turnover ratio or investment turnover ratio. We have said sales
Over
over total assets
Yeah.
or investment.
Yes.
So I'm getting a little bit confused. Total assets
These are the total assets, current and non-current.
and current.
So you take this one plus this one, the total that you will be having here as the total assets, or over what? Or over this revenue. Sorry, it will be the revenue, then you divide by the total assets.
Inclusive of those, we have used other words like investment, investments,
Forget about the word investment.
the word in here.
The word investment itself, when I'm talking about this investment, I'm referring to financial assets. Yes, not the same as this investment here.
Yeah,
You are okay now?
yeah, thank you.
But it's okay. So let us continue. We are talking about the stock or inventory holding period. How do we get that? It can be given by number of days in a year. Number of days in a year, then you divide by what? Number of days in a year, then you divide by the inventory turnover, or you can take 365 days, then you multiply by the average inventory, then from there you divide by what? You divide by the cost of goods sold. The cost of goods sold. You divide by the cost of goods sold. You divide by the cost of goods sold. The cost of goods sold. The cost of goods sold.
Hope I'm not wrong if I say cost of goods sold is the same as cost of sale.
Yeah, so it will be the number of days. It can be 365. It can either be 360, depending on what the examiner has given you. Then average inventory, you take opening plus closing, you divide by 2. Then you divide by the cost of sales. Cost of sales. Then we go to number 7, debtors or receivables correction period. Debtors or receivable correction period. We talk about debtors or receivable correction period. We have debtors or receivable correction period. Debtors or receivable correction what? Period. Correction period. Right, and say it indicates the length of time. It indicates the length of time it takes the customer to settle their accounts. It indicates the length of time it takes the customer to settle their account. It indicates the length of time it takes the customer to settle their account. So it is given by, you can take the number of days in a year, then you divide by what? You divide by the receivables turnover, or 365 days, you multiply by the average receivables, then you divide by what? Credit sales. Divide by the credit sales. You divide by the credit sales. You divide by the credit sales. 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 Then finally, let us look at the creditors or payables payment period. We have the creditors or what? Payables payment period. Payables payment period. Creditors or payables payment period. And write and say, it indicates the number of days the credit is given before payment is done. It indicates the number of days the credit is given before payment is done. It indicates the number of days the credit is given before payment is done. So therefore, how do you get that? It will be given by the number of days in a year, number of days in a year. Then you divide by what? You divide by the payables turnover, or 365 days times average what? Average payables. Then we divide by the credit purchases. We divide by the credit purchases. Credit purchases. We divide by the credit purchases. We divide by the credit what? Credit purchases. Then before we can look at the questions about the ratios, let us summarize by looking at the advantages of ratio analysis. Let us look at the advantages of ratio analysis. 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 Number 1, they are used to determine the ability of the company to meet its financial obligation. They are used to determine the ability of the company to meet its financial obligation, i.e., liquidity ratios. Number 2, they indicate the extent to which the company has borrowed external finances. They indicate the extent to which the company has borrowed external finances to finance its asset to finance its asset. They indicate the extent to which the company has borrowed external finances to finance its asset, e.g., gearing ratios, e.g., gearing ratios.
To finance it,
They
assets.
indicate the extent to which the company has borrowed external finances to finance its asset, e.g., gearing ratios. Number 3, they indicate the level of asset utilization in generation of returns or sales. They indicate the level of asset utilization in generation of return or sales, e.g., efficiency ratios. They indicate the level of asset utilization in generation of returns or sales, e.g., efficiency ratios. Returns or sales, e.g., efficiency ratios. Then number 4, they are used to compare the performance of the company with that of industry, i.e., industrial analysis. They are used to compare the performance of the company with that of the industry, i.e., industrial analysis, i.e., industrial analysis. Then number 5, used to compare the performance of the company with that of competitors, i.e., cross-sectional analysis. Used to compare the performance of the company with that of competitors, i.e., cross-sectional analysis. Another point, used to compare performance over time, used to compare performance over time, i.e., trend series analysis, used to compare performance over time, i.e., trend series analysis, trend series analysis. And finally, ratios are used to determine the value of the company, i.e., valuation ratios. Ratios are used to determine the value of the company, i.e., valuation ratios. Ratios are used to determine the value of the company, i.e., valuation what? Valuation ratios. Then we look at the disadvantages of ratio analysis. Disadvantages of ratio analysis. Disadvantages of ratio analysis. Disadvantages of ratio analysis. Number 1, ratios ignore the effects of inflation. Ratios ignore the effect of inflation, i.e., an increase in sales may be due to increase in selling price. Ratios ignore the effect of inflation, i.e. an increase in sales may be due to increase in selling price and hence may have nothing to do with increased performance. Ratios ignore the effect of inflation, i.e. an increase in sales may be due to increase in selling price and hence may have nothing to do with increased what? Performance. Another point, difference in the size of the company. Differences in the size of the company. Differences in the size of the company. Differences in the size of the company. Full stop. Then light and say that companies in the same industry may have different size. Companies in the same industry may have different size, level of technology, and diversification. Companies in the same industry may have different size, level of technology, and diversification. Therefore, difficult to compare performance. Therefore, difficult to compare performance. Therefore, difficult to compare performance. Next one, number 3, difference in accounting policies. Difference in accounting policies. Different in accounting policies. Different in accounting policies. Then number 4, ratios fail to capture the qualitative aspect of the company. Ratios fail to capture the qualitative aspect of the company. Ratios fails to capture the qualitative aspect of the company. Ratios fail to capture the qualitative aspect of the company. Another point, number 5, in case of monopolistic company, comma, therefore cross-sectional analysis cannot be effective. In case of monopolistic company, comma, therefore cross-sectional analysis cannot be effective. Cross-sectional analysis cannot be effective. Then from there, next one, number 6, window dressing. Number 6, we talk about the window dressing. Window dressing, window dressing, window dressing. We talk about the window dressing. Window dressing. This occurs when the accountant reflects a picture which never existed during the accounting period. This occurs when the accountant reflects a picture which never existed during the accounting period by manipulating figures in the financial statements. This occurs when the accountant reflects a picture which never existed during the accounting period by manipulating figures in the financial statements. In the financial statements. In the financial statements. So that marks the end of the theory part. Then what is remaining is for us to do what? Some calculations. What is remaining is for us to do some calculations. And for the calculation matters, I think it is good you are given time to go through them. And then from there, I think we can do them on Monday. On Monday, you can do them on Monday. So you have these 2 days. Is it 2 days or 1 day?
Well, that's
So you have 1 day to go through them, and then from there, when we will be doing them, at least you will be having some hint on some ratios.
Yeah.
Not all of them, but some of them at least you can be able to do what? To do them. So therefore, we are going to stop there for the case of the ratios. For the case of the ratios, I think we are going to stop there.